Jim's been at UT since before the owl. and everyone has told me that he is the best professor in the MBA program. And what he does is, would you agree with that?
I wouldn't know about that.
His specialty is, the phrase I would use is entrepreneurial finance or small company finance. So out of the blue, I invited Jim to come and talk to us about his favorite topic, and much to my amazement, he readily agreed. And here he is, and he's all ours for the next hour and a half. And so, Jim, would you like to take it away?
Yeah, I actually have been at the McCombs School of Business for this is my 31st year, I guess. So, and have been in the Austin community. I actually went to school here as well, so I've been in Austin since when the word chips used to mean tortilla chips and Mexican foods. It wasn't semiconductors. So there didn't used to be anything here in Austin except the University and State Government. So Austin's changed a lot over the years. But I taught undergraduate for about 15 years or so, and then the last 16 or 17 I teach MBA second year class in entrepreneurial finance. And then I also teach in our executive MBA program down in Mexico City. I sit on about, I guess, 4 or 5 boards of companies, a local bank, a software company, a medical device company, a medical distribution company out of Michigan, a recycling company here in town. So, and then I've done consulting work in town for a long time, working with privately owned companies, doing business valuation work, raising capital, debt and equity. Used to do restructuring, turnarounds, things like that. So, so hopefully that kind of academic coupled with the practical applications of working with small private companies, we can kind of figure out where you guys go next. So up until now, I assume that most of you have been kind of in that opportunity identification, trying to find something that looks like it's interesting space that you might could solve a customer pain, create some differentiation. And then that's the first stage of kind of getting a business started, and you really want to focus on trying to find a product or service you think has some potential. And then the second thing you do is start forming teams. So I understand y'all are working in teams on these. Well, last night, I also am the faculty director for the Venture Fellows program at McCombs School, and they have 18 MBA students that actually intern at local venture capital firms here in town, private equity and venture capital firms. And so we went over to Andrews Kurth Law Firm, and they were given a case where they had to negotiate the founder's split. So how do we split the ownership of the company? Who's bringing what to the table? How much do we get of the company? And so that's going to be your next challenge. As you get your idea, you know, do we form an LLC? Do we form a corporation? Do we do it in Texas? Do we do it in Delaware? Do we, how do we split the stock, the common stock? Do we vest the stock? What happens if someone gets divorced? What happens if they leave? All of those kinds of issues. And I will tell you, if you don't do it up front, there's, you know, you pay attorneys a whole lot of money on the back end if you don't pay a little bit on the front end to get that done right. But they negotiated, and one guy was the money guy. He put up the capital. The other two were the technical people. And so how do you split that? I mean, I've got $250,000 in this deal, and you guys got sweat equity writing code. How do we split the ownership of this thing? And that just got them the seed capital to get started. Now that we've got a prototype, we've got maybe some beta customers, now we got to go raise real money from institutional VCs or angels. Now what? Well, until you get your house in order, if they smell anything that there's dissension between the teams, that y'all aren't getting along, that you haven't figured out what roles people are going to play, everybody, because most of the time when you go and raise capital, the venture capitalists or angels are going to want a board seat. And so they may say, we're going to form a 3 or a 5 member board. We're going to take 2 seats. You guys are going to get a couple seats two get on the board, which two? And so all those issues start arising and things. So if you don't get that, but at the end of the day, you got to think about the team. It can't be about individuals. If you can't solve things between yourselves as a team, nobody's going to put money in your company. It's just too easy to say no and walk away. So we're going to talk tonight a little bit about, before I can even raise money, I have to show someone what the opportunity is, right? Now you've got to now convert that from just a great storytelling, what my product does, the features and things, into some actual numbers. So what's going to be the most important number for you to know that's going to make all your other decisions? How many people I need to hire, how many assets I need, how much capital I need to raise, all of those other things. What's the most important number that I need to have to make those decisions?
User acquisition cost?
Okay, yeah, the cost is important. What else?
Gross margin.
Gross margin, I can figure that if you tell me this other number.
How big the market is?
Okay, very good. So market size, and then what? What share of that you get, right? So it's revenue, it's demand, right? So if you told me exactly what my revenues are going to be, running a business isn't all that hard. Right? You told me exactly what my sales and revenue are going to be, then I know how many people to hire. I know how much capacity to build. I know how much capital to raise. And that's God's little trick on all of us. What's the hardest variable to forecast? Is revenue. So there's a bunch of ways to forecast. One is to say, what's the addressable market? How big is the pie? And then what size of the pie are you going to get? But if you went to a venture capitalist just with that, you'd be shot down pretty quick, okay? Because they're going to say, look, I need a bottom up too. What customers have you talked to? What does that acquisition cost? You know, how many of them have said they would buy? Give me some numbers that come up from the bottom as well, not just top down. And by the way, when you do the top down thing, if you went to a VC and said, oh, this is $1 billion market, and all we have to do is get 1%, okay, and we're all rich. What do you think they're going to say? So can you tell me who owns the other 99%? Because I've never met a market leader with one. So you've made it sound like, boy, we don't have to achieve the hurdles real low. We don't have to do much, and there's money here. But they're looking for companies that are going to dominate that space and things. If by the same token, if you said we're going to own 90% market share, you're dead on arrival as well, because I don't know if any company has 90% market share. So part of it is just being realistic about, you know, and the way you validate the top down is to come up from the bottom and say, look, here are some customers, here's some typical customers of how much they're using, here is the cost that it takes to acquire those customers. So I told my students in class the other day when Groupon went public, I said, can't wait until I can short it. And the guy said, why? And I said, well, first of all, their customer acquisition costs, they've got to market to both the merchant and to the end users. So most of the time you say, well, at some point those costs will come down. I'm not sure they do. And I think the restaurants have figured out I can't make any money with Groupon because they cut the price in half, and then they take 50% of that at 25 cents of my original price. I can't make any money. So what do you see in Groupon now? You don't see restaurants so much. What is it? Laser hair removal, you know, some kind of boot camp in Zilker Park. People that are sitting around watching Oprah that don't have anything else to do. You know, that, yeah, I'll do it for 25 cents on the dollar because I'm doing nothing right now. So I don't, you know, and there are so many copycats. The barriers to entry are so low. It's almost like the Foursquare here and Gowalla and things. The minute that Facebook put check-in on their webpage, it's over with, guys. It's done. So a lot's going to have to go into your forecast of how well do you know the industry and what's the competitive landscape. You know, what are other people doing? How easy is it for them to come in and duplicate what you're doing? What barriers have you established to keep other people out? And I've dealt with it. It doesn't have to be just in technology. One of my clients I worked with here was Guiltless Gourmet. They made baked tortilla chips. When we went into the natural foods places, They loved it. They didn't want Frito-Lay in there. That wasn't a healthy product. So we got in really easy, and we were doing great. And then the minute we tried to go into Safeway and H-E-B, who's going to pop their head up? Yeah, Frito-Lay's going to say, and you say, you can sell those, but not on this aisle. Oh, you can put his product over in the shampoo aisle or something, but not here. We own this space. And they can't do that, but what they did is said, they told the stores, we will use our personnel who are there every day anyway to stock the shelves. So store, you don't have to worry about that anymore, we'll do it. And then, so the stores looked at us and said, so y'all gonna stock the stores too, right? Yeah, we got 4 people, yeah, we'll stock the shelves. You know, what are you talking about? And so we went out to find jobbers, and Frito-Lay had already contracted that they couldn't handle any other salted snacks. And so their sales went from $30 million to $10 million in 1 year. When Frito-Lay came out with baked tostadas, it was over with. So you can be the inventor, you can have something great, but I've got to somehow show people that I can have some barriers and block people that might want to come in if I'm successful in reproducing. So the more you know about your market, your competitors, you know, what's going to make people want to buy your product, what differentiation does it have? So if you give me revenue, then I can say, all right, if I can get this much revenue per customer, and my customer acquisition costs are this, then I can start making some numbers. Forecasting expenses isn't too hard. I know what rent's going to be. I kind of can figure out head count and get payroll. So your biggest costs are going to be overhead, occupancy, and people. So I can start figuring if you give me what the scale and the volume is. So once I have that, then I'm probably spending more money initially than I'm bringing in a revenue. So how do you fund that? So you're burning cash every month. So let's say you're burning, $10,000 a month. Okay. So how much money do you have, and how long will that last you? And let me just ask you a question: how fast do you think you can raise money? Is it a week, 2 weeks, a month, 6 months? What is it?
God, I hope it's shorter than 6 months.
Probably for equity, that's probably about right. So, if I start raising money, I got 2 months of cash left before the fume date hits and it's gone. I'm not going to ever get to yes, I'll be out of business before these guys even start doing due diligence or anything. So you got to really think far ahead of how am I going to fund all of this. So let's just start from, so where do companies get money to start? So now you're ready to kind of start hiring people, taking on expenses. So you don't have Uncle Bob here giving you free rent and stuff like that. I actually have to pay for things. Okay. Now what?
Friends, families, and fools.
Yeah, 3 F's: friends, family, and fools. Okay. What if I don't have any rich aunts and uncles or parents and things? Then what?
Bootstrap.
Yeah, you can bootstrap. Okay. So what does bootstrapping mean?
You get your MVP and you do everything by yourself.
Okay, so what if I heard someone over here, they're a soft guy, they're not a tech guy, I don't have write code. Now what?
Get a part-time job and spend the rest of your time doing your company.
Okay, and that's one of the problems. We've had Moot Corp in the business school for a long time, which is business plan competition. We'll get 4 MBAs that form a team, and then they pitch to venture capitalists. The Rice business plan competition just happened last week. My problem with those competitions is I don't know very many startup companies can afford 4 MBA salaries from the get-go. I mean, 3 of y'all need to get a job and send your paycheck back to the guy that's running it, who's not taking a salary. So that's bootstrapping, right? So bootstrapping would be, but could you offer something other than cash?
To developers?
Yeah,
And you don't have anything to show?
yeah.
I haven't talked to a developer yet. I would accept that.
So, but what about a developer that's a partner? So you guys, I want to tell you something. You're going to have to make a decision early on, a big decision. Do you want to own 10% of a $100 million company or 100% of a $10 million company? Which one sounds like more fun?
100.
The 10% of 100?
Yeah.
Really? You like VCs screaming in your ear all the time? I thought you wanted to be independent and run your own company. If you only own 10%, you got 4 board members that have put in $50 million, it's not very much fun. So, yeah, it depends on what kind of control freak you are, how much capital and how capital intensive your business is, lots of those kind of things. But early on, if you say, I don't want to share control, I'm a control freak, I don't want other people involved in this thing, I'm going to run it by myself, then bootstrapping is probably for you. And now with this new Jobs Act, I can actually put a project up on Kickstarter and I'm making pre-sale things to investors, which, this is so funny to me that you have Graham-Dodd, which is the banking law that says people are too stupid to figure out what credit card to get, but we're going to let them now invest in entrepreneurial ventures. What are you guys thinking about? I mean, if sophisticated, accredited investors that are worth a lot of money, if they lose money, it was a bad decision and it was, they write it off and move on. But someone that only makes $40,000 a year that puts their last $2,000 in a Kickstarter deal and loses it, there are going to be lawsuits, there's going to be fraud, there's going to be all kinds of things that come out. But while it's there, they have made it fairly easy for you to kind of put things on and see if you can attract fairly dumb money, that will come in and give you pretty cheap capital. So there's more sources now that you can attract capital than ever before in terms of there's angel networks, there's always been high net worth people, but finding them was difficult. Now there's angel groups, there's all kinds of ways to access capital. Doctors and lawyers, I'm on the board of a little company that has LinkedIn for doctors. They can transmit images, MRI, EKGs, HIPAA compliant across this is a doctor that developed it. He went out and hired he's somewhat technical for a doctor. But he did something, he hired some programmers to kind of get this thing up and running. And then he went out and he raised $2.5 million just from his other doctor friends. Now by the way, most doctors wouldn't know a good investment they saw. I mean, God lets them make a lot of money because they lose a lot of money by not making very good investments. So they raised this money. He got $2.5 million there just a month ago. And then he said, look, I've got another $1 million being thrown at me at a higher valuation than the other guys. And that sounds great, except that if he gets his valuation too far ahead and then goes and talks to VCs, they're going to cram him down, and now your investors are all mad. So you got to really think long term. It can't be just, you have to have a financial strategy. So Bob's been talking to you about business models. That's really important. I mean, when you go and raise capital, the first thing they're going to say is, what's the revenue model? What's your business model here? So in financial terms, from a financial strategy, that's the great thing about business. There's not one way to do it. There's lots of different ways to skin the cat, right? So I could be a high margin item. So I could go into, pharmaceutical or software where there's high intellectual property, okay, and have high margins. Or I can even be Whole Foods where the margins are about 2.5%. But if I get enough volume at 2.5%, I can make some money that way through just efficient use of the assets and volume. And then the third way is the Warren Buffett way, and that's what? Use other people's money. Not mine. He's not invested in his money. Berkshire Hathaway is a holding company. I mean, I want to tell you a thing about the insurance model and the cash flow. You pay me every year and I'll pay you back when you're dead. And in the meantime, I'll invest that money and I'm pretty good at that. That's a pretty successful business model. So when you look across these different models, I can pull a lot of different levers and models. So on revenue models, it could be what? Subscription, advertising. Okay, you could do the, convert on the back end and try and do the freenomics and things like that. You could do, there's lots of different ways you could do. So a lot of times entrepreneurs are sitting there exploring, saying, all right, what's the best way for me to monetize this idea? And you will find as you get out to raise capital, some people will, that'll be hot right now, or that's old and I don't like that model. So if you came right now with just a pure advertising model, That's not going to get much traction very far. The advertising model kind of was, you know, 2002, when Google came around, that was okay. That's not so much as that your sole source of revenue now. So, figuring that out, but you've got to, the main thing entrepreneurs are storytellers. Being able to tell someone the story and show them that the passion that you have, the team you put together, and that you can execute. Because there's a lot of risk that an investor faces when they come in and invest in your company. I got market risk, will this work? Okay, I got technological risks. I've got people risk, team risk. So has anyone in here ever raised venture money, venture capital? No, Bob has. He's one of them. So what does, he's both raised it and been on the other side. Which one you like better, by the way? Like getting their money or writing checks?
Everyone loves you when you give that money.
Until they read what the strings were on that money, huh? Yeah, so when you go talk to a venture capitalist and things, you know, what's more important to them? The market, management team, momentum, what are they looking for?
I was here, it's the team.
Yeah, at the end of the day, business is always about the people. Customers, employees, it's about people and showing leadership. But a great team that doesn't have any market, is that what I want to invest in? So actually, I've asked that of venture capitalists, and they're split about half and half. There's a half of them will say, give me a huge market and I can find a team. You know, if this team doesn't work, then I've got a Rolodex and I can find the CEO and others that might make this work. And then the other said, no. If I've got the right team, they will pivot and they will make whatever it takes to make this thing work. So what they really mean is I need both. So how many of you want to be the CEO of your company? When you start it, you're going to run it and be the CEO. How many say, I don't think I have that skill set. I probably ought to get someone and bring them in because that's not me. Anyone? You already recognize don't think you have what it takes to be the CEO?
Yep.
And you're okay with bringing someone in above you?
Yep.
Very good. How many said, you bring someone over me, I'm out of here? I mean, so those are things you need to consider, because with venture capital, 80% of the time they're going to replace you as the founder with a seasoned CEO. And you have to be able to say, okay, that's all right, because I've got a pretty significant stake in this company, and I'm all right with that. The question is going to be is whether you can get on the learning curve and come up to speed as fast as the company is growing. So you did. You were able to kind of maintain throughout, right? They brought someone in over you. Were you okay with that?
After about a week.
So, yeah, I mean, at some point, remember the VCs are now on your team. Okay, and you got to have someone you can work with, and normally they talk to you and they'll say, Bob, this is why we think we need to do it, right? And they convinced you that that probably is right for the good of the team. So let's just start so we go out, friends and family, okay, and fools, and this is kind of dumb money. They did it because you're their kid or they love you, and not so much that it was a great investment opportunity. And you know, the thing about dumb money is that you got the money and it may have been lower cost, but they're not much help with running the business. And in fact, so how many investors should I have? Should I raise, you know, $10,000 from 100 investors?
That's a lot of expectations, man.
Yeah, what you will be is on the phone all the time answering calls from all. So what's going on with my money right now? So yeah, you don't want to get that many investors involved. You really want, but the thing about dumb money, if they're diluted that much, they got no individual power. So that's kind of, for a control freak, kind of sexy to go out and get things that none of those guys have enough power to really do much. But at the end of the day, they're not adding much other than just giving you some money. So more sophisticated angels, and so you now have Central Texas Angels Network here in Austin. It's about 70 investors or so, only maybe 20 of them or 25 are really active. They can write checks of upwards of maybe 500,000, up to $1 million, something like that, doing early stage deals. They now are networking. Jamie Rhodes started C10. He now is over at A&M, and they're networking the Houston Angel Network, the Aggie Network, San Angelo, Dallas, some other places, into a network of Texas Angels. And they're syndicating deals to where they can get on up into, maybe as high as $1.5 million, $2 million in syndication. And the reason that's important, the gap in entrepreneurial finance has always been, angels are pretty good at under 500,000, and then the big VCs don't want to look at anything over 5 million. So what do you do if you need 2 million, 2.5? And there just wasn't a lot of money in that gap. And there's a whole lot of companies, that's what we need. So you got two choices. Either I raise less than I need, have to do it again pretty soon, it doesn't get me very far, or I take on more than I need at a low valuation and get diluted pretty bad. So, yeah, all I can say is wait as long as you can, guys, to go after institutional money. The longer you wait, the more de-risking you take from them, because we're further down the road, we're got more traction, more validation, the better valuation you're going to get. So if you're going to raise money, just try and raise it as far out as you can. Now, some of you are going to say, well, that doesn't sound like a lot of fun. People coming in, taking big equity stakes, sitting on my board, telling me what to do. So I got this little company, I think I'll just go to the bank. They are cheap. I hear that prime is 3.25% right now. That sounds like pretty cheap money. So I sit on the loan committee of our bank. If you came in and said, I'd like to borrow money for my little startup company, how far do you think we would get?
Secretary?
Secretary? Why aren't they interested? Isn't that their job to lend money?
Like to think so.
No, hard asset.
Huh?
High risk, nothing to prove.
Yeah, so you got no track record, right? So you can't prove that you can repay this loan, okay? And so the first thing I'm going to do, by the way, is run credit. That's the first thing a bank's going to do, is go out and say, I'm going to run your credit report, and I'm going to see what kind of history you have in managing your debts. So if I run most students' credit report, what's it going to look like? Yeah, either you have no credit yet, which is worse than bad credit, which means we don't even know what's going to happen if you get any credit. But if you did have credit, sometimes I've been late on payments and things like that, and that shows up on the credit report. So if you can get past that, then the bank's going to say, well, what's our collateral? So most of you guys are doing web applications, so what's your collateral? Some code, a web page?
Our computers.
My brand. I got a brand. Yeah, that's what a bank wants, is brand. And so I have no collateral, I have no historical cash flow, so the money's cheap, but for more mature companies. So one of the things that gets entrepreneurs discouraged is that they get no because they're going to the wrong places. I shouldn't have ever gone to bank. They're not venture capitalists. You went there because you knew that they kind of gave money to business people, and you heard their money was cheap. It was cheaper than venture capitalists. But you went there and you never had a chance to begin with because you're just too early to go raise that money. Now, I will tell you, there are government programs, so state programs like ETF and things like that, but there's also federal programs like the Small Business Administration, and they guarantee the debt of businesses, and they do back startups sometimes. So under certain circumstances, a bank may say, if the government gives me a 75% guarantee on this loan, you only want $50,000. So if it goes bad, I only lose 25% of that loan. I might think about that, but I'd also think about it if you got McCombs to come and guarantee the loan. So if you got a co-signer, then that's fine. I can get some debt. But so bank debt is probably later down the road. So your friends and relatives and things, you now may go out, try and find angels. There are a lot of family offices wealthy people, individuals that run family offices. Finding them, there's not really a directory of family offices. And so, you have to kind of network with people, accountants, lawyers, consultants and things that may have access to those people that make introductions to you so that maybe you can access some of those people. Then you may join an angel network because that's the easiest way to see a lot of people at one time. But and then after you get through angels, then you're going to kind of get into, well, the next round is going to be a bigger round. So with venture capital, they actually fund through stages. So seed stage, then there's the A round, B round, C round. So seed round would be what? If I call it a seed round, how far along are you?
Early stage, just even developing a product.
Very good. So certainly, probably may not have revenue or customers yet. You may have an idea. I may not even have a prototype. How many people want to take that much risk? So it used to be there were some VCs that played in that space, but most VCs have moved later stage. That's pretty risky. And so the angels have kind of backfilled into that space. And then most of the VCs, institutional VCs, and when I say institutional, what I mean, they raise money from pension funds and endowments and things and have a pool that they're investing. But they are going to do the A round maybe, and like I said, the big problem for an A round is that they may have a minimum of 3 million, 5 million. If you went to Austin Ventures, largest VC in town, I mean, they don't do deals. If you're running a $900 million fund, I can't put that out at $2 million per investment. Because I'd have what? 400 investments or so. We don't have enough people to sit on the board of 400 companies. So they just can't write a check that small. So again, picking your venture capitalists, do they have the industry expertise? What are they training? Is it the stage of investment, size of investment they want? And you can do some research and find information about that. There's a venture capital directory. There's a National Venture Capital Association. PwC, the accounting firm, actually publishes venture capital statistics quarterly, and they will say, here's the most active VCs, here's how many deals they did, this was the average, they do clean tech or they don't do clean tech, things like that. So you can find data on the venture capitalists. So what did it take to raise the money? So I go out and I raise $3 million from a VC. How much of the company do I have left in my name as the founder?
Do you still work there?
Maybe. No, by the way, in fact, they're going to vest you. They don't want you to leave. I mean, the last thing a VC wants to do is run the company. Okay, so I'm probably going to vest your shares and make sure you don't leave.
Right.
But you may be in a different role than you have hoped. But so first of all, they're going to say, well, you don't have a full management team yet. So we're going to need to set aside an option pool to bring in some employees. So while you said developers won't take stock options and things where a startup, when I got a venture capital backing me, now it changes, right? So one of the reasons to raise money is that I can attract talent that I might not on my own. And so if Austin Ventures is behind me, and not only that, but they've got a pretty good Rolodex of potential executives that you could use, that they could help you, they can open doors to customers and things that you may not get into. So they're bringing more than just money to the table. But they're going to say, option pool, you need to set aside 20% of the stock to bring in potential new employees. And we're going to bring a new CEO in. And how much do you think I have to pay a CEO, a seasoned CEO, in options to get them to come over?
At least a quarter? 6, 7?
Yeah, 5 to 8, probably upwards of 8 on a good one. So I just used 8 of the 20 to get the head guy. And so you're now dealing with what? 80%. And now they're going to put in $5 million. So how much of that 80 should they get? 50%. in. So what your pre-money value, what do you bring to the table? How much is the company worth right now relative to what I'm putting in? So if they say, you got a $3 million pre-money valuation, okay, and we're putting in 3, then we need to own half. So how do they come up with what your value is?
Magic 8 Ball. Is that what they would?
Yeah.
It's actually called the golden rule. It's my gold and I get to make the rules. So it's collusion is what it is. All the VCs know each other, and so they say, hey, just tell everybody it's $3 million pre-money. And you can argue and say, no, I think my company's worth more than that. And then go somewhere else. You go somewhere else, and they say, yeah, it's 3.
That's not well dangerous, actually.
So you don't have a lot of power, right? I mean, they see a lot more ideas. Anyone know what the average VC, how many deals they look at, and how many deals they actually invest in? Take a guess. If you're Polaris, how many do you think Polaris Ventures looks at? How many business plans per year? What, 600 to 1,000? Something like that? So 600 to 1,000. And then you get serious and read past page 2 on how many of those.
Hardly any.
100? Maybe just look a little further under the covers. So about 900 of them go right into the trash can. Why?
They just go over.
Wrong industry. I mean, you're not even in the industries we invest in. Or you're not in the stage that we look for. The amount of money you're asking for. So those are pretty easy screens. Just say, so the funnel's this big, but it comes down pretty narrow.
You left out the first screen, which is, I never heard you.
That's right. Where did this come from? You got my name over the internet and you sent me this business plan. So I got 1,000 business plans. I can tell you where the stack is yours went. So in 2018 we might get a look at that. So yeah, if you got to have someone that introduces you. So if an attorney or a banker or someone calls and say, look, I've looked at this deal and you guys ought to really look at this. But a lot of VCs are actually investing in serial entrepreneurs. We backed this guy before, so we know who he is. So if you're the new guy and you have no reputation, they've never heard of you, I mean, you're fighting uphill battle from there. So how did this get here? How do we know these people? And then, they'll read the executive summary and say, does this fit our criteria? And then they maybe look at 100 and then get interested in maybe 10 or 15. And then there's competition. I mean, I like this deal, but someone else does too. And I got to fight over to get the deal. So I took my venture capitalist out to Silicon Valley. And as we were meeting with the VCs, and it's different here in Austin versus out there. I'm going to give you guys some strategy here. If you're from Austin, okay, and you go out to San Jose in Menlo Park, and you're from Austin, what do you think the first question the VC is going to ask you?
Where's your cowboy hat?
Have you talked to Austin Ventures? I mean, they're the big gun in town, and they're in your backyard. Have you talked to them? If you say, yeah, I did, and they didn't like the deal, get back on the plane now. I mean, if they didn't like it, why do you think we would like it? And VCs like investing in their backyard. I need a lead that can go there and see things, oversee things. So what the strategy is, a lot of companies in Austin are going to Silicon Valley first, and when they say, have you talked to AV, say, nope, because I don't think it's a good fit. I think you guys are actually the ones. So when you come back to Austin, if they tell you no, when you come back, AV doesn't ask you if you've been out to the valley. They just assumes that you're from Austin, this is your first stop. So, little strategy in raising money. But I asked these guys, I said, so what's the difference between Silicon Valley and Austin? And they made some interesting observations. One guy said, great technical expertise, but no product managers, no sales managers. So they can build a company up, but then they can't scale it and things because there's no talent in Austin. In Austin. And I said, well, why do you think that? Well, first of all, Austin grew up on enterprise software and semiconductors. So it was B2B, not B2C. And so there weren't a lot of people that had consumer. And so if you were a CPG company or a web, consumer web company, when you went to get financing, and none of the VCs funded that because all they did was enterprise stuff. So when you went to get funding, you went out to the valley and then they said, yeah, we'll fund you, but you got to move to San Francisco. So all of the talent was out there. So around there, there's plenty of those guys. So that was one thing they point out. And then the other interesting thing they said was, we don't like investing in Austin because we see the entrepreneurs are building features and products, but not companies. So I had a VC that's managing $800 million, and they said, you know, if someone comes in and offers an Austin entrepreneur $25 million for their company, they'll sell and they want out. And they said, $25 million doesn't move the needle for us. We're looking for the next Facebook. We're looking for the next Google. We can't just bail at $25 million. It doesn't do anything for us. And so they said in the Valley, most of those people are on the same page as them. We're either going to get 10x our investment back or it's going to be zero. But we're going to die trying. Whereas in Austin, you say, you know, $25 million in Austin is not a bad lifestyle. You know, and so it's a different culture out there. So Bill Gurley at Benchmark told me, he said, yeah, he said, my biggest job out here in the Valley is convincing the entrepreneur to take our money rather than Sequoia's or Platters. Really? Here, Austin people walk around and say, man, whew, can't believe that VC gave me any money. It's a totally different culture that they have out there. So if you've ever been out to Menlo Park and Sand Hill Road and things like that, you think these VCs are managing $50 billion and things, or in these big high-rise towers and things. You get there, and it looks like they're in a dentist office. They're little two-story buildings and everything, but there's one every 100 feet. You know, you can, within a quarter mile, talk to 50 VCs. So all the venture capital is concentrated on the East Coast, Boston, New York, okay, and out in California. And then Texas is kind of the third largest economy, but has very little capital relative to the size. So you may have to go outside of Austin and things to find. So U-Ship here, those guys are actually funded out of the Valley, not here. They went out and got funded out of the Valley. So you may have to find the right investors to invest. So I raised this rounds of funding, and then when these guys put their money in, how long are they in for?
Tell your portfolio.
Yeah, not always. I mean, Pandora they were in, and it's never been profitable. So we went public, and we're still not profitable. How long are they in? What are they looking for? What kind of rate of return? I said the bank money was cheap. You can get bank money for 5–6%. How about a VC? How much?
Yeah, you mentioned 10 times.
What's 10 times mean? What annual rate of return are they looking for? 10 times is about 62% is how it works out, something like that. Now, they shoot for that. Do they get that all the time? The average VC portfolio averages in the neighborhood of around 25%. So they shoot for 60, but they're going to lose 4 of the 10 investments. Get 0. It's gone.
25% annual?
Huh?
25% annual?
For the portfolio annual return, right? They shoot for 60% annual.
So why not just play the stock market?
Because stock market, you're not going to get them at 10 or 12%. And that's why the S&P 500 long-term is average 10%. Okay, so that's a long-term average. So if I'm a pension fund, I'm underfunded, okay? I have underfunded my pension. So the only way that I don't have to contribute more money is if I can convince the auditors that I can make 8% on my portfolio. Well, to be safe, bonds and stocks, that's hard to do with just bonds and stocks in the public market. So I have to juice the returns by doing what? Investing in private equity, venture capital, real estate, things like that. So they will give that money trying to get a much higher return for taking higher risk. So VCs are set up as 10-year partnerships. The first 5 years, they call on the capital and then they invest it. The second 5 years, they are, you know, harvesting their investments. And then they return the money back to the limited partners. Okay, and then the arrangement is they get 2% management fee and then they split the profits after their money's returned to the, capital's returned to the limited partners. They split it 80-20. So that limiteds get 80, the VC gets 20. And so with that, after all those, the limited partners might get, you know, 20-25% returns on average. So I might have had 1 or 2 home runs that actually got me 10x my investment. I've got 5 that got 0. I've got the others that gave me 2 or 3 times my money. So when you average it all out, most of the time they return about 2 to 3 times the limited partner's capital back, something like that over a 10-year period. Now, it's the only industry that if I don't do a good job, what happens at the end of 10 years? Looking for a job, right? I don't raise another fund, that one's ended. So there's a real incentive for me to pick the right companies, because if I don't get to raise another fund. So they're going to be picky. They're going to say, I'm going to look at 1,000 deals, get down to 15, 20, and probably fund maybe 4 or 5 deals at the most per year.
And this is like large-scale VCs?
This is all VCs. I mean, basically, the size of fund just affects the size of the investments they put in. But most of them, depending on the number of partners. So there's now has the advent of these super angels. So Mike Maples out in California, you got a bunch of Google and people like that. Here in town, Rudy Garza at G51 kind of has, he used to be known as a small VC, now he's a super angel. And so he's got a small fund, and he's got a pretty small staff, but Rudy doesn't always lead the investment. He's tagging along with someone else that's the lead. So the other VC, S3 Ventures here, Silverton and things are fairly small funds. They may have, you know, well, S3's raising like 20 million at a time, but they're on their 4th fund, so they got about $90 million under management. Versus an Austin Ventures that has 800 million in the current fund and almost $4 billion under management total. So much different scale. Here in town, Vista Equity just moved in, okay, and they're moving their headquarters here. They also manage about $4 billion, so AV finally has some competition. They haven't for 30 years, so AV's kind of been the king of the 800-pound gorilla. But Vista Equity only does software, nothing else. That's it.
What about DFJ Mercury?
DFJ Mercury is actually headquartered out of Houston, but they have a local Austin office. And they are early stage investors and fairly active. So is S3, so Silverton was, they're kind of at the end of a fund and things. But those guys are the ones that are kind of doing those smaller early stage investments. And Austin Ventures, of the $900 million fund they had, $600 million was for growth capital, so that they did home away with that. So that's a roll-up. They just bought companies that were already in existence and combined them and then went public. They're doing the same thing with Whale Shark right now, which is affiliate marketing companies. They bought Retail Me Not and things, and they're just rolling them up and then take them public.
So the model works.
Yeah. And by the way, the risk is a lot less if I see that you're already making $2 million in revenue and $600,000 in profit to buy you. Now I have to pay a premium because the valuation will be higher because you're profitable versus taking the risk of someone that has no profit. But the risk is a lot less for doing that. So 600 of their 900 is doing growth capital, and the other 300 million is really for venture stage. Okay, so let me just, I'm going to pull up a couple of slides here and just kind of show you a couple of things. go out and start raising capital, guys, I mean, I have to have, and used to be you wrote full-fledged business plans. Today, you would never get through all of that. You're gonna have a slide deck that has about 8 to 10 slides that kind of says who's management, what's the opportunity, what are the risks, you know, what's the opportunity, what are the exits that they could have. So you're gonna go through and kind of have that all summarized. And then they may say, now that you've got our attention, we want to see more detail in your business plan. But the actual using the business plan itself as the tool to get in has been replaced with really probably a slide deck. But you've got to have some forecasts. When they start asking questions, how did you get your revenue forecast? What's your head count? How did you estimate that? So all those kind of questions you're going to have answered before you even go in and start raising capital. So where do you go for the money? The answer, Deans, is, you know, where are you in the company's life cycle? Are you a startup? Are you a growth company? Are you mature? Are you declining? Where are you? Most of you are in that startup phase. How much money do you need and what is it going to be used for? So it doesn't matter if you go to the bank or VC, they're going to say, what's the use of proceeds? So let's say you somehow you've got $50,000 of your money in the deal already. And then you say, look, I want to raise $1 million and I'm going to use $50,000 to repay myself. How's that going to go over? So you're going to use our money to take your money out? This is such a good deal, you're exiting while I'm coming in? I had a VC one time tell me he flew into Austin and the guy came to pick him up. He was driving a BMW and had golf clubs in his back seat. The VC saw the golf clubs, turned around, got back on the plane and left. Said, you don't have time to play golf. That's your contribution. I'm putting in money, you're putting in time. And so the old days, I mean, you would operate out of a garage, you bootstrap it. Even venture funded companies, capital efficiency is the word these days. VCs want to see capital efficient businesses. Somewhere along the line in the 1999-2000, so when you hear people say, well, venture capital is really tough now, relative to what? It's about the same as it was in the mid-90s. They're funding about the same number of deals and so forth. The number of VC firms has fallen from 900 to about less than 600. A lot of these can't raise additional funds because their track record hasn't been good. And so it's consolidated. That's not necessarily bad because there was too much money chasing things in 99 and 2000. So if you say, relative to how easy it was to get money in 99 and 2000, if you just said, you know, we're going to add some more bandwidth because there's this convergence of media and television and audio and things. VCs gave you money to go lay some fiber. And it was just too easy to get. But there was a firm here in town named Agillion. Yeah, Agillion. And they were stealth mode. Nobody knew what they were doing. But these were seasoned entrepreneurs, so the VCs backed the entrepreneurs. And what they were doing was a CRM system for small businesses. That small business couldn't afford Siebel and SAP and things. So they were going to do something that was smaller scale. And that for small businesses, it will only cost $50,000 or $100,000. I don't know if y'all have ever dealt with small businesses, but their IT budget is $19.99, meaning $19.99. And so they raised $65 million in venture money, took out a Super Bowl ad during the Super Bowl in 2000, had Aryan chairs in their office all over the place. So anything but in the garage and bootstrapping. At the end of 4 years, they closed down. Anyone want to take a guess at what their revenues were on that $65 million of venture?
Negative.
No, they had revenue. $168,000. Just managed to get all the way to 168 over 4 years. Okay, they had all the revenue they produced.
Great auction for their furniture.
Yes, it was. In fact, they made more money selling the area chairs than they made selling their software.
What was the name of that company again?
It's called Agillion. It was, and that's how, see, today, if you raise that kind of money, VCs were just dumping the money in your account, and there were no milestones, there was nothing. They would just give it to you and say, go out there and be first. Today, you would have milestones. I want to see you've hit customers by this time. I want to see you've hit this revenue. So they're not going to advance all that at one time and just let you run off with it. So how much money, how are you going to use it? So I want to see, how are you using the money? Are we going to hire developers? So most of the business plans I see, I will tell you, I will take their revenues and cut them in half. I will take their expenses and double it, and I will take how much they say they needed money and triple it, and I'm going to be pretty close. Because entrepreneurs look through rose-colored glasses. I want everything to go perfect. I'm never going to stub my toe, and so you need to build some cushions in there. But you'll see, oh, we got this much to do. I need to raise $1 million. $900,000 is for development, and $50,000 is for marketing. Spoken like a real engineer.
Yeah.
And that's part of the problem. What's the background of the founders, and if they're engineers, they see the world one way. And that their marketing strategy, if we build it, they will come. And if they don't, they're stupid, so they shouldn't get one anyway. That's not a marketing strategy. Marketing people, on the other hand, marketing people will love to spend money to make money. So the top line will look great, but that bottom line, not so much. And accountants and lawyers, if you let them run the company, what happens?
Penny pinch every second.
Analysis paralysis. Yeah, I mean, there's fear and danger around every corner. So, guys, it takes a team. You can't get biased one way. You got to cover where your weaknesses are. So I want to see how you're using the money. How scalable is the business? So that's the problem. You get people that come in and say, I want to raise venture money for a little dress shop in Westlake. Sounds like a good idea. Tell me how that's going to scale. So there are 25 million privately owned businesses in the United States, and there's only less than 15,000 publicly traded companies. And the ones in the paper are about 7,000, so a lot of them are bulletin board, pink sheeted, and things like that. So very few companies ever learn how to scale and get big enough. So sometimes, I'll tell my students, maybe what you ought to do is go to work for GE and learn how to scale. Work there for a couple of years and then come back and figure out how they get from the lab to $100 million. And it's hard. That's why there's not that many, and with Sarbanes-Oxley, if you can't get to at least $100 million in revenue, the chances of going public until this new Jobs Act. They now have lowered the standard to comply with Sarbanes-Oxley the first 5 years if you are a emerging company. And so as a result, they're trying to stimulate new IPOs at a lower level of company. So if you're under $1 billion, you don't have to comply directly with Sarbanes-Oxley right now. And most companies that go public, technology company things, none of them are raising $1 billion outside of Facebook and a few people like that. By the way, how would you have liked to have been Instagram? And I can tell you what Sequoia is going to do. Sequoia put in $50 million on a $500 million valuation, and a week later, Facebook buys it for $1 billion. So can someone calculate the rate of return if you doubled your money in 1 week? So most of the time, VC's talking about how many times they return the capital, like return 2 or 3 times capital. I can guarantee Sequoia, the next fund, is going to say, we have 100,000% IRR. And then finally, who's management, what's their track record? And then one of the things is going to be, so how much skin do you have in the game? Okay, so if you have access to capital and you're not willing to put it in the same way on the bank, when we come, we'll ask for personal guarantees on loans most of the time. And the entrepreneur say, I don't want to do that. And so you look at them and say, why? Do you think something bad's going to happen? Because if it isn't, then you shouldn't care. If it is, I don't want to risk my money either if you're not going to risk yours. So it doesn't always take money, but I want to see you've got skin in the game from the standpoint of sweat equity. You've done something that you got to lose if this doesn't work.
Yeah, before you move on.
Yeah.
I just had a question about
think? What do you think?
I mean,
So
I
did someone
don't
get
know.
in cheap, or did someone overpay?
Well, I guess I was wondering if you could talk a little bit more about it, because I don't know enough about this specific. I like Instagram as a feature.
Well, in other words, Instagram actually, a lot of stuff they were interfacing through Facebook, so
Right.
they could see the traffic increase. So once they raised that $50 million, I gotta say, ooh, not only are they getting increasing traffic, but now they got money, and they're backed by one of the premier venture firms.
Right.
So he tried to buy them twice before. He tried to hire them, and then he tried to buy them twice before. Now, your first reaction is to say, well, why would you dilute yourself? Why would you go give away $50 million and dilute yourself in shares if you knew a $100 million offer was coming? And my answer is, I think they used the funding to force Zuckerberg to up his ante.
Was it a situation, because I mean, Twitter was really interested too, and so it was a situation where Instagram was worth more to Facebook because it was worried about Twitter than it was worth to Sequoia relative to other VCs that it was competing with.
Yeah, but even more than that, I think what Instagram did is said, I just raised $50 million. Sequoia is now an investor. If you don't offer enough money, okay, then they'll never agree to sell. They'll just say no because they've got to get a return on their money. So if you can't offer them a big return in a real short period of time here, they'll just say no. So one thought is that that's what they did, was use this funding to force Facebook's hand. And now we find out Zuckerberg didn't have board approval to do it.
Oh, really?
You didn't need it.
Huh?
You didn't need it. You guys, what, like 57% voting?
Doesn't matter. That's a board issue.
Oh, that is?
Yeah, that's not a stockholder issue, that's a board issue. So, I mean, that's part of the problem. When you sit on a board, are you just a yes man? Or do you really have a real board? So before I had invested, I said, wait a second, you got a board, but Zuckerberg gets to make any decision he wants to?
Right.
So how much do you trust him? How many M&A deals has he done? Does he know how to value a company, and was $1 billion a good value? I mean, so you start asking those kind of questions. I'm on one board that they had a real problem. The CEO called me, and he had a real issue he was dealing with, and I said, look, why don't you just bring that to the board and let us discuss it? And he said, I don't bring anything to the board that I don't know what the outcome's going to be. That's not a real board, guys. That's a bunch of yes people.
Right.
That's not what you want.
Wasn't that kind of what the city is facing this morning, where the shareholders backlash because they expected that, because the board was so yes-oriented.
Yeah, and compensation, I mean, the shareholders turned down the compensation.
It was $15 million too, right?
But that is a rebellion against, they say, we're tired of that. You guys, see, as chairman of the board, I appoint people to the compensation committee.
Yeah. So but that was like $15 million compensation of Citibank didn't seem like anything. Like, that doesn't seem like a very large number.
Based on what, the wonderful track record they have?
I guess the money flowing through the financial industry in general, like, it just didn't hit me like, oh my God, that's so horrible. But when it came out, they kind of planted the flag.
Well, I'll tell you something funny about executive compensation. If you go back far enough, you'll see that the unions didn't like CEOs getting big pay and when there was no performance. So the CEOs got said, well, how do you think it ought to be done? And they said, well, it ought to be tied to performance. They said, so what do you want it tied to? And they said, how about stock price?
Crap.
Okay. So the problem is now, the average CEO on the Fortune 500 stays about 3.5 years. So what does long-term mean? So I'm going to do stuff that maximizes shareholder value now, and if it hits the fan 5 years from now, I'm not here. And so that's what we're starting to see, is some of these things are coming back that are biting you that were done before. But I think the shareholders just said, look, until you prove performance, 13 million seems like a lot, given that we almost went bankrupt. And my problem with the bailout, by the way, is that they had to save the banks. If they hadn't have, then we would all been panicked and in lines, and it would have been the Great Depression again. But they should have wiped the shareholders out.
Right.
There was no reason why you bailed them out. You made a bet, you got the upside when you guys were making all the money, and now you bet and you lost the bet, and you should have been washed out.
So
And had they gone to bankruptcy, that's what would have happened. but they didn't let them go to bankruptcy. They bailed them out and let the shareholders kind of keep some equity in the company.
So money should have gone straight to operations and absolutely nothing goes to like shareholder.
Yeah, and even then, and then now you got, things have changed so much. I mean, now you wake up and the stock market's so volatile because Greece hiccuped today. When I went to school, most of us probably couldn't spot Greece on the maps. I mean, a tiny little country, how can they control the whole capital markets? And mainly because Germany can't let Greece fall, because they do, then there's contagion, it goes to Spain, it goes to Portugal. So I was watching Professor Siegel from Wharton the other day talking. He thinks the euro actually is going to trade at par with the dollar within the next 2 years. And his theory is that the only way to save the European Union is to make their goods so cheap for exporting, and that the Germans and all the northern states are going to have a competitive advantage so they can bail out the southern states, and that's the only way they can do it.
Well, that's how Germany got out of their thing, is they
So
started.
save your money, guys. It's going to be cheap to go over to Europe and go to Paris and things. Get pretty safe, so save your money.
What do you think about the way Google is splitting their stock?
Who?
Google?
Yeah. Well, I've never owned Google stock. I love the company, but I've never been able to build a financial model that shows they were worth $600 a share.
Right.
And part of the reason is I can't build a growth rate in that shows that they can have that kind of value. And the other reason I didn't do it is when they first went public, they kind of have that Ben and Jerry kind of stuff, where they, you don't get to vote, but we do, and all kind of stuff. I don't like that. I mean, there's conflicts of interest when you have that. And so when they start messing with the capital structure like that, you're losing me, because you're creating conflicts of interest that don't need to exist.
And that's what they're doing now, right? They're splitting it, but they're taking away.
Yeah, but if you think about it, Google's still primarily an advertising model. If you said, so how fast is the advertising industry growing? And the answer is, it's a mature industry, it grows at 3%. So they're taking market share, but at some point, you're going to grow at the same rate as the industry of 3% unless you find other revenue sources. So while I like Google Maps, I just don't know how you monetize that.
But is that the same for internet marketing? Because isn't that growing much faster than actually marketing or advertising as a whole?
That's right. So they're taking market share now, but once I've got all the low-hanging fruit, and I am now, the old television and radios, everybody's advertising through me, then how do you continue to grow? And see, I have that same problem with Facebook, in that, do you think the Chinese are going to let Facebook come into China?
No.
Because they looked over in those Arab countries and said, ooh, you come on Facebook and they kind of throw you out of office. So the Chinese are going to say, no chance of that happening. So you got $1.5 billion people, plus they have a competitor, Chinese government. But they're not, that growth is cut off from them. So they've already got maybe as many users around the world as they may get. So how do you continue that growth? So if it's fully priced, the growth is already fully priced in the 100 billion, then where do you go from there? So while you can love companies and their technologies and things like that, and you think they got a lot of potential, sometimes the valuation gets ahead of what the future is.
I don't want to go on a tangent. I just said look at Africa, look at India, and mobile, and which phones are going to hit those markets and the mobile advertising power, and that's how you start to pump Google stock.
Yeah, you can, and Android and all that may take off and stuff, and I know that Africans know something about computers because I get an email all the time.
It's a great investment. Told me to go to the airport for it.
And I'll tell you what China's doing is going over and building roads and infrastructure and schools in return for resources. And I mean, we're missing that. So, yeah, if you say, where's the next cheap labor market? I mean, China's already figured that out. It's going to be over in Africa, and they're starting to build the infrastructure things necessary for that. All right, so you can really break money into two big categories, creditors' money or owner's money. And there's a lot of different things. I could go to vendors. So guys, don't be afraid to go upstream and downstream. People that have a vested interest in your success because they want to sell you something or they want to buy something. So they can become, customers can become, shareholders or creditors. The advance payment, okay? If you can get someone to write you a check up front to develop it and deliver it later, that's all that Kickstarter really is, except in a small scale. But they've been doing that for a long time. There's new funding out now, royalty-based payments. Okay, so instead of me taking ownership in your company, I'll give you money and then I'm going to take a royalty of 6% off the top. So I'm not on your board. Okay, I don't care how you manage your expenses. I don't even care if you're profitable. I get 6% of royalty no matter what. So that's been around for a while, but it's making a comeback. Asset-based lenders, you guys don't qualify that, but if you had heavy assets, you could go borrow against assets. Factoring companies, anyone know what that is? If you had accounts receivable, you can sell those to a third party and get financing that way. So I wouldn't lend to you, but your customer is IBM. So I will lend to IBM. So if I can verify you've done the work and they're going to pay you in 90 days, then yeah, I'll advance you money to make payroll on Friday. So I can buy the receipt. That money's really expensive, okay, but it is a source of capital. You got banks, leasing companies, government-backed loans, merchant banks. Capcos are venture companies that are funded by insurance companies. They get a tax break. Most of the time these guys do subordinated debt, which means they come in behind the bank and the senior lender, they give debt money at usually about a 12% interest rate, and then they take warrants to buy stock at a penny a share. And the warrant coverage will get them to about 18 to 20% rate of return. But remember that they're pretty unsecured. They're behind another lender that has all of your assets. So that's what Capcos do. On the owner side, you got the founders, home equity loans, retirement accounts. Is that a smart idea? They got a big loan on your house and cash in your IRA? So if the business failed, now you're homeless, okay, have no money, and you have no business. Is that? I mean, so there's lots of people who do it. There's a company here in town called Trilogy, okay, that when they got started, they did it on credit cards. Okay, there were 5 guys that went and took out 75 credit cards and took cash advances on those credit cards. Now, Joe Lamont said, look, there's 5 of us. Rather than all 5 go bankrupt, let's go and put them all in my name so that only one of us goes bankrupt. So guess who owns most of the stock now? So he took the risk and he got the biggest share of that. So MasterCard and Visa are the largest venture capitalists in the world. They just don't know. Actually, they do know it by the rates they charge. And then you got the 3S, and then profits that are left in the company. There's business angels and private placements to wealthy individuals, venture capitalists, strategic investors, okay, and then private equity groups as you get older. So usually can break these into debt and equity.
So when you were saying VCs look for how much skin you have in the game, is that what they're talking about? Putting your home on the line and cashing out your IRA?
Not necessarily, but they want to know that that you have, I've got 10,000 man hours in this right now. Right. And I've foregone this salary for this amount of time. I'm an MBA, I could have been making $100,000. I've been at this for a year and a half.
Right.
Now, that's not the same as my real dollars, but I'm going to give you credit for the fact that you didn't just wake up with this idea and think that I ought to take all the risk and you don't have any skin in the game. Now, I'd be worried if you were independently wealthy and had a bunch of money and you're coming to use my money rather than yours, and I'd have to say, why? Say, well, I don't want to risk mine. I would have a problem with that. Debt estimates, they're senior, credit enhanced with guarantor, subordinated debt, which is sometimes called mezzanine, high interest rates usually for those things, and then there's convertible debt. Now, we're seeing a lot of that with the angels right now, and they'll come in and say, look, we don't know what the value is, you're too young, so what we'll do is we'll give you $100,000 and call it debt, but it's convertible into stock at the next round of financing. So So if you go out and get an A round and they determine it's $3 million, then we have the ability to convert based on that valuation, but usually at a discount. So the way I sweeten this is to say you can convert at 80 or 90% of the next round of financing.
Jim, is there a convertible debt, are you making an interest payment on that?
No, it's payment in kind.
Okay.
So they accrue the interest, and then when they convert their principal and interest, so it gives them
What's
more
the
equity.
typical interest rate on convertible debt right now?
Depends on what you have to negotiate with that deal, but I'm seeing 8%, something like that on a lot of those deals.
Would you be able to buy them out before they convert instead of letting them convert to?
No, I wasn't just a lender, I was taking a lot of risk here, so why would I just lend to you at 8%?
Right.
So it's hard for them, I mean, they don't want to be capped on the front, on the top, if I'm taking all the risk on the downside. So most of the time, yeah, I'd convert, and then if you want to buy my stock back at the most recent valuation, we can talk.
How do you feel about convertible debt in general?
The problem as an angel investor, I'm probably going to get crammed down by the VCs. They're going to say, why does Jim get a 20% discount just because he came in 6 months or a year ago? So if you want us to put the money in, you go tell Jim he can come in at the same price we are, but we're not going to give the discount. And otherwise, Jim can get the $3 million. So what do you think? And most of the time, they'll cave and say, okay, I'll come in. Sometimes, remember, VCs come in at preferred stock level. You own common stock. So if you are an angel investor, I would like to convert not into common, but into the A round with the VCs. And then the VC will say, well, but we're paying $1, you get 80 cents. Why? You said, well, because I took more risks. I was in a year ago. They said, look, it don't work that way, guys. So you'll find that the guy that's the most recent round of financing has all the power.
I see.
If I need to restructure and redo deals, if these guys are putting a little bit more money in, but I'm putting the lion's share, then I get to kind of dictate what the terms are going to be to the previous investors. The other problem you have is dilution. Let's say you put in 100,000 and that's your last 100. And then when you go out and they raise another round, you can't contribute anymore, so you used to own 10 and now you're diluted down to 3. And then they raise another round, you're diluted down to 1. And so each time they raise funds, if you can't participate in things, then you end up owning very little.
But as a startup, how should we feel about taking on convertible debt?
Yeah, it's fine because it bridges the gap. If we get in an argument on how much this thing's worth, we got no customers, we got an idea, you got a patent, you got some intellectual property, but I don't know how much it's worth. So we can sit there and argue, and if we argue where you don't raise the money at all versus taking the debt, then you take the debt.
Okay.
And the angel, it depends on the angel. Again, you want to pick the right guy that's, a team player. You don't want an adversarial relationship from day one. And then finally, equity, again, preferred stock, and it could be convertible, cumulative, participating, all kinds of things that they can build into the preferred stock offering. And then generally, the common stock is voting, although you can split the stock and have voting and non-voting and so forth. So this is kind of the financing life cycle. So you can see founder capital, friends and family, angels. And a lot of this depends on what stage of development you're in. As you can see, so the more mature you become, the more debt and cheaper sources get. When you're young, you're paying the more expensive equity financing. And if we look at percentages, your friends, family, banks and things, they're down there in that 5 to 10, 15% range. When you get early stage VC, you're out there in that 50% range. That's pretty expensive money. And you say, well, I'm not paying that 50. No. If you were in Facebook and you put in $5 million, okay, and they took 25% of your company, and now when you go public, you're worth $100 billion. 25% of $100 billion is a pretty good return. And so that's the problem. It's in ownership. It's in equity. Now, if you go broke, then it was pretty cheap money. You didn't pay anything back. But if you actually hit the home run, that money is really expensive. There's bootstrapping we talked about. Okay, this is bank underwriting. I'm going to leave you with this slide, and then we'll do do some Q&A here real quick. Banks look called the 5 C's. So they look for cash flow. So a startup, you got cash flow? No. Collateral. Yeah, I've got some code in the website. Okay, not good collateral. Character of the borrower. How do I determine that? I pull in a credit report. Okay, and I'm going to look and say, how has he handled his credit in the past? That shows character. So if I look in there and you filed bankruptcy, you hadn't made your child support payments, you got tax liens, I've seen some of the nastiest credit reports you've ever seen. And the scores go from like 400 to 850. And you look at someone that's got a 400 credit score, you take out life insurance and then hire someone to kill them. That's the only way you're going to get paid back.
Sell the movie right
there you go. Capacity means, does your balance sheet have the ability to take on debt? Capacity, do you have the equity base to borrow? And then conditions mean, what are the economic and financial conditions of the company? So right now, our bank, if you came in and said, I'd like to do a retail strip center in Austin and want to borrow money, what do you think we'd say? No, we're not interested in retail right now, in real estate right now. Mainly because most of the banks are concentrated already, they've got too much real estate, and the examiners have said, stop doing that. So if I do it, I just make them angry. So I don't want to do that. So I may actually blacklist a whole industry saying, look, I'm just not interested in doing that right now. How about a restaurant? Yeah, anyone know how many food trailers are in Austin, by the way? 1,800.
I'm sorry, what?
1,800. Okay. Now, somewhere I got lost in the fog, apparently, because when I was growing up, that was called a roach coach. And now it's gourmet dining somehow, and I just missed that. But Franklin's Barbecue, Torchy's Taco, all of those guys started a trailer and have gotten pretty successful. So, instead of software guys, y'all need to go figure out how to cook. So, they're everywhere. Two of my German students have this Verts. They converted that little smart car into the most efficient German engineering I've ever seen in my entire life. Every inch of that car is for making sandwiches. I mean, they got their own water supply, their own electric supply, and it's all in something that takes up a half a parking spot. So how well do you think they did during South by Southwest?
Oh, yeah.
They just sat there and got 4 of these cars and just located them at Trinity and 7th and just sold sandwiches like crazy. So the problem is, anyone know what the failure rate of restaurants is? 80%. And if you're a bank, okay, if you're a bank, how much do you get for used forks and glasses? Especially when it says Chinatown or something on it. I mean, you get nothing for that, So, now if you're Uchis and there's a waiting line at 3 o'clock in the afternoon, you just sit there at the end of every day and count money. So if they're successful, they're really successful. So banks will say, I'm banking on a restaurateur, I'm banking. So if the guys from Chewy's come in, I'm saying, okay, those guys, I can probably bank them. They know what they're doing. They own Hula Hut. They own all these others. I'll back them. But if you said, someone told me my food tastes good. I'm a good barbecuer. I don't think so. So which of those C's is the most important, by the way?
Cash flow.
Character.
Character.
Yep.
So my credit history.
So if you got bad character, it doesn't matter what the numbers say. If you're going to stiff me, I'm going to lose my money. If your reputation and character is so good that you'll work 2 jobs to get me repaid, I'm probably in good shape.
Like that club owner downtown, he was working 2 jobs.
Yeah. Unfortunately, that's why a lot of restaurants fail. They have a second business on the side. Not only that, but it's all cash business. So how many of you think are skimming money and cheating on their taxes and things like that? I mean, there's a lot of things that can go wrong in all cash business like that. So you got debt sources. That's probably later in your life. But if you came in even without collateral, but you say, I make $1 million a year in cash flow, and you got good character, I'll lend to you. unsecured without the backup collateral, because if I can count that those cash flows are pretty secure and coming in, I would lend on that. But that's going to be later in your life. When you're first starting out, you'll be either bootstrapping in your own capital and things, or you're going to have to go get partners. And if you get partners, you have to know that they generally are going to go on the board. Okay, they're going to say, I want a 5-member board. And a lot of times, institutional VCs, you're going to have to incorporate in Delaware. Have any of you ever been to Delaware? So the VCs like to be in Delaware. They want you to be a C Corp, not an LLC. And the reason is, LLCs and S Corps pass the money through the company to the investors, and then their partnership, so they would pass it through to their limited partners. And the LPs said, no, we don't want any of that. And so they will force you to convert usually to a C Corp. So my advice to you is go and talk to an attorney and do it right from the very beginning, because it can cost you to convert later for taxes, a lot of things like that. So go ahead and do it right from the very beginning. Yeah.
So in terms of exits, if the VCs are typically looking for an exit, which is either an acquisition or an IPO, what happens if there's a company that's profitable, but it's not at that level? Like, what happens to that company typically?
Well, generally, there'll be a put at the end, because remember, they got a 10-year partnership. So if you haven't had a monetization, then they may say, look, you go do a recap, go borrow money, you got cash flow to service debt, go borrow money and buy us out.
Gotcha.
So I'll have some kind of ways of putting the stock back to you to get liquid. Theoretically, a VC can actually give the stock investment that they own to the limiteds, but no limited wants privately owned stock. So they force some kind of a conversion or something usually. But these days, the chances of going public are so low that 90% of the exits now are through acquisition. And there again, as you guys are doing software, what if Microsoft is your acquirer? Most of you didn't work for Microsoft. Why? Because I hate Microsoft. I didn't want to work for Microsoft because they're Microsoft. And then all of a sudden, they said, now we've acquired you. Oh, and by the way, we'd like you to move to Redmond.
Yeah.
Where you'll be in an apartment the rest of your life because houses cost like $100 million or something. And you say, I don't want to do that. So the problem with acquisition is people don't like the culture, and then they do what? They want to leave. So I just bought something where the people that wrote the code just all walked out the door. How hard is that to integrate? So in technology and software companies, that's hard. Now, some do it well. Cisco, got to be a Fortune 500 company through hundreds of acquisitions that they integrated really well. But the vast majority of companies, the cultures are different things that a lot of them are just not successful. But that tends to be the method of exiting now, is to find a strategic buyer or another private equity firm that, remember, there's a whole bunch of raised money that need to invest money, and a whole bunch that invested back in the early 2000s need to leave. So I just found my exit. So I had a client call me the other day. He said, Jim, Goldman Sachs called me. I'm in their private equity fund. And they said they just sold a company, and they were sending me a check for $3 million. And I said, great. And he said, and then Morgan Stanley called me the next day and said they had just purchased the company, and they were having a capital call, and I needed to send them a check for the purchase of this business. It was the same business. He was on both sides of the transaction. So he said, I think the $3 million, I made a pretty good return. I'm not so sure when I reinvested how good that's going to be. So you're seeing a lot of sponsor to sponsor, private equity buying each other.
So a lot of those big VC firms, are they like houses like Goldman Sachs and Citibank?
Yeah, most of the banks now have formed. Bain and consulting firms have their own VCs, as well as some of the big banks have their own thing. But the big ones and things that are out in the valley are independent. Sequoias, the Kleiners, those guys aren't having any trouble at all raising money because they're top tier. They can raise a fund. And if you think about it, if I'm a limited partner, why would I give money to you, a little startup VC, if I can give it to them and their name, their brand, their own fund, 10, 12, they're going to see the best deals, right? If you really got a hot idea, aren't they going to get to see the Facebooks and the Twitter? And what are you going to look at? And so there's a tendency to want to give money to the older firms. The problem with that is some of these VCs are now in their late 60s and 70s. They're rich, they're on Fund 12. How hard do they want to work? So probably that younger VC that if they don't get in the top 25% of the industry, they're out of the industry. They probably work pretty hard to be successful. So in other words, how do you run a football team without a farm club? How do I find succession and things? So a lot of these older VCs are going through the industry's maturing, and how do we pass on to the next generation? And a few have blown up. A few didn't do that very well.
Is SoftBank still around? I don't hear much.
You know, I haven't heard much either, so I don't know. But, you know, but the big plan, and then all of them are kind of getting into, you know, clean tech got to be hot, but not in making ethanol plants and things. That's not capital efficient. I don't want a solar plant like Solyndra and things like that. But if it was smart grid, if it was a new LED light bulb or something that I could get a fast return on, look at that. But I don't want to get into heavy capital intensive where the end commodity is electricity or gasoline. That's more project financing, that's not venture. And so they're staying away from those types.
Isn't that, I mean, Bob, you talked about how, you know, the internet is not going to save the world on its own, or another internet company. Is that maybe part of the problem? Is that
Tell me where you think 50 years from now, what's going to be the U.S. economy?
Data.
I mean, that's what I'm afraid of. Is that what we're going to tweet each other where we're eating? Can you build an economy on that?
it's so low risk now. Like nobody wants to do anything that has any overhead or physical
That's right.
product. And it's,
So I don't have to buy big iron and servers anymore. I can host. SaaS makes it easy to get in on the software side. So yeah, that's why it's all moving that direction. But at the end of the day, can we all just kind of, you know, do e-commerce between each other and it's all made in another country and all we do is we're consumers? Is that going to be out there? We're pretty good at that, by the way.
Yeah, we're good
We
consumers.
spend money. So, I mean, so what does the economy look like?
So do VCs ever invest in like technology commercialization programs in
Now,
universities?
Emergent here is, that's all.
Yeah,
of it.
ETI is the thing.
Now, Emergent Technologies here is a VC firm that they try and commercialize. Now, the problem with UT is, for a long time, OTC had a sign that said closed. Go away, we don't want your money. And so they got a reputation of being hard to work with. Whereas other, you know, Stanford, their doors open, said, you guys are right across the street at Sand Hill, come on in.
Right.
And we'll fund your deal. And we're a state institution, so our lawyers want to paper everything. The royalty has to be right. And
Right.
Stanford said, okay, go out there with this technology. If you make it, remember us. And they remembered them with about $500 million. So there's no amount of royalties I could ever collect that would equal $500 million.
Right.
So, but as a state institution, they're just scared to death because if the taxpayer, if someone got your technology and then something happened to it, the taxpayer's money was, so hard to work with. The bureaucracy's pretty tough.
What about the model that Berkeley uses? Isn't that a little bit more open?
Yeah, Berkeley, Stanford, but you know,
I mean,
so, but Berkeley's California.
Okay.
California may not even know Berkeley is doing that. So, I mean, people are afraid to go to Berkeley's campus. You may never come out. So yeah, California, you can't use California as your standard. I mean, but most state institutions, now, Ohio State, they're much easier to deal with. They have a technology thing than what Texas is. So, but the president knows we're getting a lot less royalty than most other big institutions like this. So he would like to see more revenue coming from the intellectual property. It's just that we don't have the processes and things in place to be able to do that efficiently. A&M's better at it. A&M's better at it than we are.
Really?
That pains me.
I don't like to hear that.
Yeah,
Is it
Carol.
better than it used to be?
Yes, a little bit. Although we change directors every year. So there's been no leadership there for any sustained period of time to get into traction. Yeah. So any last questions?
Yeah.
Go ahead. Let me get over here for a second.
I just have a question about convertible debt.
Uh-huh.
So let's say you raise, you get convertible debt, and then you never raise the Series A
can convert it, whatever that appraised price is. Now, appraisal fees are not cheap, so what if we go and get an appraisal and the company pays for it, and I like the appraisal, but you don't? So do you have the right to go get another appraisal? And what if it comes in and it's a lot different than the first one? So do we average? Do we go to lawsuit and mediation? Do we hire a third appraisal and then do some? So there's some way of determining that. The question is, how much does it cost? But they'll have that. They'll have things if we get bought before there's another round. How do they do that? Is it convertible and at what rate? So they'll address all of those issues in the document. Yeah, so you'll do that. One last thing.
Yeah, you're a baseball manager. You want every one of your players to think he's the best person to play that job. You want them all to think they're the best guy
Yes.
on the team. You don't want anybody who's comfortable stepping back. You don't want any pitchers who are comfortable handing over the ball. So if you're a VC, what is the opinion of leadership of a startup where they're looking at it like, we like this company, but we think we need to put someone more experienced in, or maybe a couple people. Do they want a startup that's comfortable with that, or do they need that startup to be so hungry and a little bit
Yeah, you want them to be cocky and that we're gonna succeed, that's good. The bad news is if you're inflexible and say, I'm gonna be CEO and that's it. You're dead on arrival at that point. They would never agree to say you're gonna be CEO no matter what.
It's being patient and being like, yeah, we're comfortable bringing in somebody who, might have more experience. Is that seen as soft and weak?
No, not at all. It's that if at the time they're a better candidate to run this and accomplish the goals of the team. I mean, it is a team sport, but here's the problem. So do I hire athletes that are real versatile that can play in any position? Or do I go for functional roles for you to fill and do this really well? So I remember, y'all are probably too young to remember this, but UT played Miami in the Cotton Bowl about 15 years ago. And UT changed from wearing white shoes to black shoes. And when I'm watching that game, I said, man, those black shoes really make them look slow. It wasn't the shoes. I mean, our Mike Brown's deal is let's go find 340-pound guys on the line that can sit there with all this beef and blah. And Miami said, let's go get a bunch of athletes that are faster than hell that those guys can't catch up to. And they had a better model at that time. But for most entrepreneurial companies, you want people that are filling roles, okay? Someone that doesn't do anything really well, but does a lot of things okay, is that really your guy? But I don't want someone that says, well, my job description doesn't say that. And I'm the CEO, I took the trash out, so you can too. And I don't want this high horse thing of I've got a degree from UT and I don't do trash. That is what you don't want. So you want them to be a team player. You want them to not be disruptive. You could get a star, but they're not a team player and be so disruptive. Same thing on board. If you got 5 board members and one of them is just hard to get along with, I mean, you don't get anything done. And it happens at the managerial and all the other levels too. So, yeah, picking the right people that have the same vision, and that's part of the problem. You form a company here, these are your buddies, okay? You give a third, and a third of the equity away, and then 2 of them decide to go out and work somewhere. You just gave away 66% of your company to people that aren't there anymore. So I need vesting. I need a way to get those shares back. If you leave within a year, you get 0. If you've been here a year and a half, you vest, you own 6% or 25% of the stock, we'll pay you for that. But there are golden handcuffs for the people that are creating the value. You don't get to just, do it and then leave. And who should get more? The idea guy? Or the guy that has the contacts to the VCs? Who's more important? And those are the kind of things when you start fighting over who's bringing more to the table, instead of thinking, how do we make the pie bigger? And then my share will be worth more. I'm fighting for that same small pie and I want more of it. You're dysfunctional at that point. Nobody's going to invest. At the end of the day, guys, it's people. Okay? Customers, employees, you've got to have enough charisma that people want to follow you. You gotta have enough passion that you love, and you'll work harder than everybody else to make it happen. You gotta be strategic, which means everybody sees the bus that's about to hit them. The question is, can you look around corners and see things that other people don't see? I mean, everybody sees what's obvious. And so strategic people are going to be the people that really get out there, understand the customer, understand their markets and things. And there's a shift in the supply and demand curve, and I can get there before everybody else. If you can do that, you can be successful. And I will tell you, most wealth in this country is made from entrepreneurs these days that are successful. So if you decide to go to work for a big company, that's another nice, you'll have a nice managerial lifestyle and thing, and you may even make big dollars as an investment banker and other things, but at the end of the day, entrepreneurship's where wealth is created. Okay, so don't give up on the dream, guys. I mean, nobody said it was easy. If it was, nobody would work for other people. You'd all be self-employed. So it's hard. But you got to stay with it and believe what you're doing, and then surround yourself with people that are better than you. That's why I love teaching in an institution I couldn't get into. You guys, SAT I wasn't within 3 standard deviations of what your SAT score was. So, and I've been here for 31 years letting me teach. So I've enjoyed it, guys.